and get ready for another riveting, amazing, thought-provoking, actionable episode of Risk and Return with Charlie Gasparino and Bob Sloan. By the way, we have a 2 for or 3 for the price of 1, if you want to count me. Your partner, Ihor Dusaniwksy, expert researcher, made his bones on the AMC GME short. We'll maybe get into a little bit of that with Ihor. But first, Bob, before we get into what Ihor has to say, I'd like to see some of your actionable ideas this week.
But we have a couple of new picks for next week. The first, we have a couple of bearish calls. One is on Credo Technology Group. They're reporting Monday after the close. We're bearish on that. The second is Campbell Soup, which is reporting Monday before the opening, and we're bearish on that. But interestingly, very interestingly, just given all the talk about the consumer and what's happening with the consumer and the court decisions around tariffs, we are very bullish about Dollar General. They report Tuesday morning, and we have a bullish call on DG as we think that the price action as compared to short interest is very bullish for that stock.
And that would run counterintuitive, in my view, since they import a lot of their stuff from Canada. Maybe it's oversold. I mean, what do you think's going on there?
We just think that this is a very short-term signal. It's only good for a day. And the way we look at it, the way price action is reacting as it runs up to earnings in comparison to short interest, it leads us to believe that you'll see a pop in the stock for that day, that one day.
Okay, that's good. What else is on your plate, Bob? Anything good?
Well, we got a couple of different things. I think it'd be a great time to talk a little bit about what we spoke about last week with Jim Chanos. I mean, I don't know about you, but boy, I could have listened to him for a really just an amazing amount of time. He's so prescient and, often early on a lot of things.
He's very early. Listen, if you want, he's, as most people know, he shorted Tesla. The stuff that he raised on Tesla was maybe wrong at the time, but you can see those concerns popping in the stock now, clearly popping in the stock when Elon was doing the Doge stuff. People were like focusing micro on all the production issues that Jim brought up. So, I mean, Jim Chanos' research is usually really solid. This is not an easy game calling a short on any big stock, particularly a stock where there's a lot of motion surrounding. Remember, Elon was a darling of the political left by when Chanos was shorting the stock. Chanos, by the way, is no rabid right winger. He just saw the numbers, right? I mean, Jim was, I believe, a staunch Democrat based on what I know about him.
100%.
But he saw the numbers. Yeah, so he saw the numbers. He didn't like what he saw. And I would say a lot of his concerns are bearing some fruit right now when you see some of the stuff going on with Tesla. His call, as if you tuned in last week, was on MicroStrategy. He went short MicroStrategy and long Bitcoin because he believed there's a huge, am I saying this right, delta between the two that needs to collapse?
That's right. That's right.
Is that the trading
price is equivalent to the
stock? Like a Goldman Sachs trading desk right now or something?
Well, it's interesting to me is that the thing he is shorting is a hedge. He's creating a spread trade on a company, and he's realizing that the spread is very large. The cash to the actual underlying, the stock to the actual underlying, in this case being Bitcoin. And he's creating a nice arbitrage for himself. And, one of the things that we wrote about this week is that there's a lot of copycat trading going on. So Jim has started this trend where people are saying, yeah, if I go out and buy Bitcoin and I issue shares, the public, this is very much the way like foreign shares and ADRs work out. So the locals can only buy what they can buy. And that's why the whole ADR market was created. So what's happening here is that if you don't have a wallet and you're not familiar with Bitcoin enough and you don't want to go through the hassle, you buy the shares. And this is creating an arbitrage, which Jim has been exploiting, and that's the trade he put on. So a very interesting change, I would say, of what he's highlighting for himself as a spread trade, rather than just an outright short. Although he did mention IBM, which, I think got a little lost in the shuffle, and is very interesting play on AI and its effect on those businesses that are consultancy heavy and body shop heavy. So I thought that was a great interview. And, there's a lot of stocks out there. There's Mara,
Well, we should point
Riot,
out,
CLS.
we should point out that over the past week, looks like MicroStrategy has been down. So
That's right.
Bitcoin, so he's, remember, he's a long-term, his shorts are long-term,
Exactly.
Bitcoin over the past week. Bitcoin's down a little too. MicroStrategy is down more. Bitcoin is essentially flat.
Right. Well, maybe this is a good time to introduce my fellow colleague and someone I've been working with a long time. Ihor Dusaniwksy is the head of our predictive analytics here at S3. Ihor, welcome. It's great to have you on.
Great, thanks.
Ihor,
Thanks for having me. What was that? Sorry.
Yeah, we were just wondering if the AMC apes have screwed with your mic, but I guess not.
No, that was years ago. That was a fun time. With
they forgot about you.
And
Right, they forgot about you.
Never
forgot about
yeah.
Unfortunately.
Ihor,
You guys are sitting pretty far. I got to follow Jack Devine and Jim Chano.
Well, listen, he's called you out and called your research out many times on X. It's not unusual. He did that last week too. We have a new fellow here, Sam Pearson, where Jim actually read the piece and said this was a nice write-up. So he does read stuff, and he's read your stuff and been very complimentary. Ihor, tell us a little bit about MARA, Riot, and CLSK. You have a very interesting take on these spread trades that are going on and the copycat trades.
Yeah, these are all Bitcoin and blockchain trades. What you've got is a huge momentum push in a lot of these names that is really pressing up the stock price more than the value of the stock. It's not just a fundamental play, and that's the key. You're not looking at the fundamental value of the company. You're looking at what the investors are doing to the stock. And that right now we're seeing a big premium to stocks, to equities, as opposed to the actual cryptocurrency. So, and Bob mentioned it. He says, there are a lot of people who don't want to go and open up a wallet and figure out how to save a 52 symbol password and go through all these problems. You know what? I'll buy MicroStrategy. I'll buy Riot. I'll buy Mara, and I'll get my Bitcoin exposure there.
Ihor, so let's transition to something that you've been working a lot on. We've been talking a lot about it at S3. One of the things that's very, very, very important for every investor to understand is the structure of not only the long positions, but the short positions as well. And we've done a lot of work. And one of the more fascinating things about data, and we'll probably do a show about this later in the summer. Hopefully we can get, we've got our feelers out to some great data people that really understand why data is so important, because you hear about it more and more and more when you're talking about investing in markets. We need data. And one of the things that we've been looking at is the long market is something like 85 times larger than the short market. However, what's happening to a lot of really widely held stocks is that the amount of tradable long position and the amount of short position, a lot of the times are equal, or they're in a very interesting proportion. And Ihor has written a fantastic piece, which we will drop and put this on X for people to read. It's a wonderful piece. And Ihor, maybe you just want to walk the audience through some of the battleground stocks, what you're seeing, how we're looking at this as a firm and how it can be useful to those listening in today.
Sure. I mean, bottom line is you have a company's float, but 3/4 of float is held by passive investors, pension funds, ETF providers, and stock holders that never sell their stock. They're just buying and holding. So really, you only got a handful, around a quarter of the float that's trading in active hands. So I don't care what some of these big holders are doing with their stock. I care about what the hedge funds and these big active traders are doing, because that's the dollars that are hitting the tape and actually moving stock prices. So I want to know where you got big shorts, where you got big longs in the active hedge fund community, because that's where you got volatility in stock price. And so you've got stocks like Microsoft, which is just a major long, virtually very little short selling. But then you've got some of the battleground stocks, which means you've got a lot of long hedge fund holdings and you got a ton of short hedge fund holdings in the same stock. So basically, whatever happens in the news, whatever happens in the momentum, you might have capitulation on one side or the other. So you're gonna have these big moves in stock price. So let's talk about some of the battleground stocks. We're talking about Moderna, Sirius, SoFi. You got MSTR. You've got S3AI, AMC, HIMS, Kohl's. I mean, you get all sorts of stocks. Novavax. But those are the names where if one side capitulates or the other side capitulates a little bit, you've got a huge run in the stock. So what we say, Charlie, you mentioned before, the delta, the changes in stock price, the changes in momentum. There's also something called gamma, which is the rate of change of change. So things can be going really, really smoothly, slightly up, and all of a sudden shoots up or shoots down. That sudden change is really important to investors. It's a really important thing for investors to monitor, saying, hey, I'm gaining weight or making or losing 3, 5, 7, 8%. The big problem is, do I have a 20% loss on the horizon or a 20% gain on the horizon?
And just to make this clear, you make it clear which of those stocks are vulnerable to all that, right? In that piece.
Yeah. So I basically, in my report, kind of said, here are a bunch of stocks that are big long holders. Here's a bunch of stocks that the shorts are really in. And here's the stocks in the middle where who knows what the hell's going to happen. But when it does happen, this is going to get a big move.
Oh man, got to read that. That's must read. Ihor, thank you. Appreciate your time. I'll see you on Twitter. Stay out of trouble. Stay away from AMC. No, just kidding.
No, you're right. Take care. Thanks for having me, guys.
And now we're going to go to Gaspo's headlines. Charlie, what do you have for us? I would say that would be the first time in our very long relationship you've had nothing. That's what I would say.
Nothing to say. That would be like first. That would be like a first. But I do have a lot to say. Listen, lots of interesting stuff that I've been snooping around on. Kind of an interesting take on Trump's war on woke colleges. I mean, this is fascinating. So, I mean, the story essentially is, the headline story is that Trump is basically wants to change the political persuasion of colleges from left to right. He's basically saying, if you want to be a bunch of leftists, you want to indoctrinate kids into leftism, no more federal funding, no more perks. Elite schools like Harvard with a $50 billion endowment gets, like, as a tax exempt status, is not really taxed on the gains on its portfolio, right? I think they pay a 1.4% excise tax, essentially a tax on gains. I mean, nothing like compared to what hedge funds pay and what everybody else pays. Not even like carried interest. It's not carried interest, right? I mean, this is really like a gimme. They get tax exempt status, they get federal funding, they get all sorts of stuff. Trump is stopping all that, and it's causing a serious upheaval in the college financial ranks. Now, we should point out Wall Street does essentially a lot of advising of these colleges. Now, you would think it'd be a field day for Wall Street advisors, but they're telling me no. Here's what's going to happen. The CIOs of these colleges are going to, because they need access to cash, they need liquid cash, They have to move out of what they've been investing in the last 10 years, which is heavily investing in private equity and hedge funds, and move it into passive investments where their money's not locked in. It's not in some sort of risk-based trade, like a yen carry trade, that, something that takes some time to make money. They were used to the 8% returns, and that's what they were booking. They need passive investing. So Wall Street, the big hedge funds and private equity, could lose some money here. They're going to lose business because these CIOs of the colleges are going to move into S&P 500 funds, NASDAQ funds. I mean, that's going to be a defense mechanism, and they're clearly worried about that. I talked to a few that said, this could be it for me if I lose my college endowment or some money. One hedge fund manager told me. Another story.
But the liability stream that these folks have to manage they can't ignore that. That's why they have to they target a lot of these hedge fund and private equity investments, is because they're looking for a better performing bond. And that's exactly what a lot of the multi-strats do. So they've got a real conundrum, right? If you're forced out of these trades, you're also forced to really recognize that the liability that you're trying to cover, pensions, et cetera, people's salaries, that's a huge problem to solve, right? So really interesting stuff.
It's a huge nut. It's a huge nut. And, here's where it gets really interesting. I'm giving you a meta analysis here. I'm sure there will be people who say we're sticking with some private equity, sticking with some hedge funds. Some of our hedge funds run money that we have access to. You can sell private equity, not easy. Harvard and Yale have tried. It's not the most willing buyers out there, but they use a lot of these endowments for operating expenses, and their operating expenses, if Trump goes through with everything, they're about to go through the roof. I mean, the excise tax is going to go from 1.4% if the Republicans have their way, and it looks like they will, to like 21%. That's a lot. That's a corporate tax rate essentially. So they need access to cash. So that's kind of what is going on here. That's the debate. So stay tuned on this. Again, you would think Wall Street would love it because they need advice. Well, they need more than just advice. When it doesn't take much advice to say, let's put our money in a S&P 500 fund. So remember that. That's kind of what's going on here. The other story I'm working on, Bob, is Target, which was I found this fascinating because Brian Cornell, the CEO of Target, is a guy that I featured in my book, Go Woke, Go Broke, The Radicalization of Corporate America. And, he went all in on wokeness. He's a big defender of DEI. He's the guy that did all those very flamboyant Pride Month displays that really turned off so many people, turned off his traditional customers, and this was back in 2023, and quarter after quarter, he had some sales problems. I mean, really, people were boycotting the company, and most recently he's moved away from that. And during his recent earnings call, where they missed estimates, both on the top and I think on the top and bottom line, by the way, the EPS was down, revenues were down. He basically blamed it on the counter backlash to DEI, which I found fascinating. That he thinks it's the counter backlash that's occurring now, not the backlash or increasing backlash. I mean, what came first, the chicken or the egg? I will say this, and I quoted some people that follow the stock. Target has had problems literally since the moment it went all in on woke, when people on social media started saying we should boycott. So I think this is deeper than just a counter backlash. At least that's what some of my reporting said. I did ask Target for a comment. I have yet to hear back from them. When I do, I will next week. I'll feature it on Risk and Return. My last piece of reporting I did was kind of interesting about Jamie Dimon. Lots of stuff about when Jamie's going to retire. I mean, for some reason it came up. I think there was an investor day when someone asked him. And so I tried to nail him down on is it 2 years? Is it 4 years? Is it 10 years? Is it never? And I will say this, the best I could say is that nobody knows for sure. He had some health. I mean, let's back up. Jamie Dimon's probably the best banking CEO ever invented. Miraculous comeback in his career. Remember, he was fired from Citigroup by Sandy Weil, came back. Citigroup floundered without him there. almost went under during a financial crisis. He was at J.P. Morgan, which became, with its fortress balance sheet, became the most powerful and maybe one of the greatest American companies of all time. He had some health scares. He's a cancer survivor. He survived a heart attack. Be that as it may, he's talking about succession right now. So everybody's trying to pin him down. And from what I understand, he really doesn't know. Could it be 4 years from now? Yeah. Could it be 5 years? The board does not want him to go. Does he have a succession in place? I think, he has this someone named Marianne Lake, who he's very, very high on. She's the head of the consumer bank. I think Jamie doesn't want to stay there forever, where he keeps losing potential successors. He's got a deep bench. There's other people that he likes as well. But I guess the best part is stay tuned. I don't think Jamie Dimon knows.
Well, Charlie, in your discussions with him and folks at JP Morgan, do you think the culture at JP Morgan would allow for co-heads? For the longest time at Goldman, it was co-heads. And it just seems like these places are so big and so complex. There's only one Jamie Dimon that understands it from the ground up. What do you think?
I've been covering Jamie for a long time, we're talking decades. I think one of the problems he hated under Sandy Weil was that Sandy had a bunch of co-heads. I think Jamie might have been a co-head with Derek Maughan or somebody. I can't remember who it was. Remember Derek Maughan? He ran Solomon Brothers back in the day. Sure. That was a company that he and Sandy bought. And, those co-heads breeded a lot of management dysfunction. And, I think that's what Jamie believed. And that led to his ouster, back then. Other things did as well. I mean, Jamie Dimon is a much more seasoned executive now. He's 69 than he was back then. He was a very tough guy. Obviously extremely talented. He would say he made mistakes as a young banker and manager. My gut is he doesn't like a co-head. So I don't think you'll see a co-head. Now, you may see a CEO. This is what if I was to bet, say, put your finger on the chopping block and bet. 4 years, he resigns as CEO, gives it to Marianne Lake or someone like that. We'll see. 4 years is a long time. And he stays as chairman. Larry Fink is in the 70s, and he's clearly running BlackRock as well as he's ever done. I would say better. He's getting better with age. Larry's as sharp as ever. His management is spot on. He did that port deal. We're gonna at some point get Larry Fink on Risk and Return, and I'm gonna ask him how he ever thought about doing that port deal, which needs to be signed off by the Chinese. By the way, it's all caught up in this China war stuff. That CK Hutchison, where BlackRock bought about, I'd say, 25 ports from them, including the Panama Canal, which Trump wants in U.S. company and U.S. company hands. As you know, CK Hutchison is a Hong Kong-based China company. It's all wrapped up in these negotiations. But Larry is playing a long game. He knows a lot about China. So be that as it may, I don't want to turn this into a Larry Fink discussion until we get him on. But Larry's doing it at a high level in his 70s, and I think there's a thought that Jamie can do it as well.
Sure. And what are your contacts saying about the ruling today and yesterday, potentially taking the tariff policy of the administration and blowing it up?
Yeah. Now, this is something that no one's really saw coming. But by the way, if you listen to me, and I believe we addressed this on Risk and Return and my Twitter feed, there's something called the International Trade Court, the Trade of International Commerce, the Court of International Commerce. It's a small court in New York City that does have jurisdiction over federal trade policies. Trump was sued by someone saying that a portion that his sweeping tariffs were, under an emergency declaration, did not comport with the law prescribing emergency declarations. The court ruled against Trump for them. I will say this: I don't think it deters him. I think he's gonna. I think the market's reaction today to it, which was essentially flat, is indicative of that. It's already being appealed. The ruling has stayed. I think he goes ahead. There are other levers he can, from what I understand, he can push on terms of trade. So, and I think this could go to the Supreme Court, where the court is in his favor. Right. So, if I was to net this out, I don't think it makes much of a difference in of itself. But it does raise some issues about the legality of the sweeping nature of his trade edicts. So you might see more challenges. I think that's a big thing. And it also gets to the messiness here. I mean, I'll be honest with you, Bob. This sort of question marks around trade, I don't care. I know the markets are better now. We should point out that European stocks have done, maybe I'm wrong here, a lot better than U.S. stocks. The S&P is flat. The NASDAQ is down. This is since the beginning of the year, since all this began. We haven't really made up that much ground. There is a premium that there's a risk premium associated with U.S. securities right now because of trade, and I don't think any of this is good. And I just be really careful. I know the markets like it. This is my 2 cents. Buyer beware here. Everybody is digesting, and I heard this at Milken, the rosy scenario. Remember the whole notion of a rosy scenario? Everything, green tulips, the whole thing. Green shoots, I think maybe it is green tulips as well. Green
Right.
shoots.
Green shoots.
Yeah. So it's no matter what, we're getting higher tariffs, right? Whether we like it or not, whether Besson puts Band-Aids on all this shit, that's got to be net not good for inflation. And and then throwing a little uncertainty, and I think he's playing with fire with his agenda and with the economy. But what do I know? I'm just a simple country reporter, Bob.
With the best contacts in town. Telling us like it is, as always.
I appreciate that, Bob. But let's end it there. This is Charlie Gasparino with Bob Sloan. Another thrilling, chilling episode of Risk and Return. Catch us next week.